again for joining us here today and taking some of your time to be here with us. Again, my name is Tom Sawicki, director here at Sikich, as Rachel mentioned, on our local government services team. I have about 15 years of experience here, working on a variety of our local government clients. And I love cash too, so happy to be here presenting this topic for you all here today. So again, thanks for joining us. Nice to be with you here today. And then I will turn it over to Victoria to introduce herself.
Thanks, Tom. I'm Victoria Daly, and yeah, I like cash and investments too. I'm a principal here at Sikich. I live in St. Louis, so I work out of our St. Louis office. And I've been working in public accounting, specifically in states and local governments, for almost 15 years. So with that, I will go ahead and start the webinar. I'm going to go ahead and turn off my camera first. All right, oh, do we have a first polling question first?
Yeah, let's launch that first poll. So this is for CPE. It'll pop up on your screen. So please select the number or I do not need CPE. I'll give everyone 15 seconds to get those in.
Okay.
And you're all set.
All right, thanks. All right, so today we're talking about accounting for cash and investments, which is a topic that used to be pretty simple and just seems to have gotten gradually more complex. So we'll go through a lot of those complexities for you today in our session. It's such a complex topic that next month we're also talking about cash and investments, just a different component to it. So today we'll focus on display, and then next month we'll focus on disclosures. So years and years ago, back in 1979, before some of us were even born and before others were in the profession, we were following NCGA Statement Number 1, which was the first set of generally accepted accounting principles for the state and local government industry. It had one line of a standard in terms of how to account for the largest asset on our balance sheet at the time. So this was pre-GASB 34, before the reporting of capital assets. So at that time, the largest asset was usually cash and investments. And they said that accounting for cash and investments, that we should report cash and investments at cost or amortized cost. And that's all it said. And from a disclosure standpoint, we should disclose the fact that we accounted for cash and investments at cost or amortized cost. So the reporting was much simpler for a number of years, from 1979 to about 1984, 1985. And then GASB was formed in late 1983 and started issuing pronouncements in 1984. And since GASB was formed, we have a large amount of pronouncements now covering both accounting for cash and investments as well as disclosures for cash and investments. As you see on the next slide, it covers anything from GASB Statement Number 9 on how to prepare cash flow statements, which is reporting cash in and cash out, to GASB Statement 25 on how to account for investments for defined benefit pension plans or defined contribution pension plans, which has since been superseded. Tom's going to cover Statement Number 28, accounting and financial reporting for securities lending transactions. The next GASB, though, GASB 31, is going to be a focus for us today, which is accounting and financial reporting for certain investments and for external investment pools. So for those of you that might participate in a state-sponsored external investment pool, this tells that investment pool how to maintain their books and records. So if you're in Illinois and you have the Illinois funds, or if you're in Wisconsin and you have the Wisconsin Local Government Investment Pool, or in Missouri with the Missouri Local Government Investment Pool, this is what those pools have to follow when preparing their financial statements. Continuing on the next slide, GASB 43 goes over post-employment benefits, GASB Statement 53 on accounting and financial reporting for derivative investments, which we found that fewer and fewer governments have been investing in any type of derivative investments, instruments due to the different markets that we have nowadays. So we'll just skim over that one. GASB Statement 67 on accounting and financial reporting for pensions, which gives us guidelines on how to account for investments with pension plans. More recently, GASB issued statement number 72 on fair value measurement and application, which we will cover a little later today. Also, GASB statement number 79 on certain external investment pools. And those of you that participate in those pools, how you should account for that participation, whether that's at fair value or at cost or amortized cost. And of course, the note disclosures related to that. And last but not least is GASB interpretation number 3 at the bottom of your slide there, which is financial reporting for reverse repurchase agreements. So these are various GASBs that we will be covering related to cash and investments. And since GASB 31 is pretty much the backbone of accounting and financial reporting for cash and investments, that is going to be our focus for a little bit now. GASB Statement 31 provides guidance on accounting and financial reporting for cash and investments in all funds within your reporting entity, with 2 exceptions. So any cash and investments in your governmental funds is going to follow GASB 31, and so will cash and investments in the proprietary funds and in the fiduciary funds, except for any single employer or multiple employer pension trust funds that you have, or any OPEB trust funds. So those would follow the specific guidance from GASB Statement number 67 for pension trust funds, or GASB Statement number 74 for OPEB trust funds. So we do not apply GASB 31 to those 2 types of funds. Otherwise, we apply GASB Statement number 31 again to all cash and investments that's reported as part of your reporting entity. Statement number 31 also provides guidance for states or other governments that establish and run investment pools. Generally, GASB Statement number 31 requires you to record the majority of your investments at fair value at the end of your reporting period. Whether or not you keep them at cost or amortized cost throughout the year and prepare interim reports for your board at cost or amortized cost is up to you and up to your investment policy and up to state statutes. But GASB tells us at the end of the year, now you should be reporting these investments at fair value if you meet the criteria. So what's the specific criteria that we have from GASB Statement 31? Well, Statement 31 tells us that for certain types of transactions or certain types of investments, we have some choices to make. So first and foremost, for equity securities, GASB says that these are always at fair value. Open-ended mutual funds generally are always going to be reported at fair value. So then what we really have to look at is debt securities. Do we report debt securities at fair value or not? And most of you invest in debt securities, whether those are certificates of deposit from a local institution, certificates of deposit from a broker, U.S. Treasury obligations, U.S. Treasury securities, corporate bonds, state and local government bonds, whatever it may be, any type of debt security. So GASB is very specific guidance for us, and that's the 3rd bullet that you see on this slide. So now it says participating interest-bearing investment contracts, which is what a debt security is. Why it says participating is if the fair value of your investment changes based on the market change on the interest rate environment, that is a participating investment contract, and those should be kept at fair value if at the time you purchase that investment, it has a maturity of greater than 1 year. So this is from the purchase date, not as of your balance sheet date or your fiscal year end, but at the time of purchase. And you'll notice we're going to have some different rules for defining these as we go throughout this. Also, just keep in mind that this is for fair value reporting, not for cash flow statements, but for fair value reporting. So any debt security you purchase with a maturity of greater than 1 year at the time you purchase it, you have to report that at fair value. Now, the only exception to that is certificates of deposit for only non-negotiable certificates of deposit. So non-negotiable certificates of deposit is, for example, when you go down to your local bank and then you open up a CD, then they give you a piece of paper, or you go online and open one up to evidence that the investment in the CD, and then they're going to pay you a certain percent interest on the CDs. And there's an exception here, because what happens if you bought a 2-year CD and you need to get those funds before it matures? So can you sell that CD on a secondary marketplace, the non-negotiable CD that you buy directly from the bank? And the answer is no, you can't. So those do not have a fair value, and those do not participate because they won't change fair value based on changes in interest rates. So instead, what happens if you need your money early, you go and you ask the bank and they'll give you your principal back, but they'll withhold some of the interest as a penalty for cashing that CD in early. So that hopefully helps to explain why there is that exception for non-negotiable CDs. So a negotiable CD, on the other hand, is a CD that you're generally going to buy from a broker, and a broker will buy a large block of these and divide them up and resell them to local governments or to investors. Negotiable CDs do have a secondary marketplace. You can sell it back to the broker or sell it to one of the broker's clients. So therefore, negotiable CDs are impacted and do participate in changes in fair value, and therefore should be reported at fair value again if they meet that definition of a maturity of the time of purchase of greater than 1 year. So that's the key component to the definition of a participating interest-bearing investment contract with a maturity at the time of purchase greater than 1 year. Then we're going to record at fair value, as well as any equity securities and any open-ended mutual funds. So there's a big change. That's a big change from the original NCGA pronouncement, which told us we basically just record everything at cost or amortized costs. Now, one thing to remember was Statement 31 as well as Statement 72. It established a minimum for fair value reporting. So they say at a minimum, any remaining maturity greater than 1 year when purchased has to be at fair value. So now, can you choose to mark your entire portfolio to fair value if it only has participating investment contracts? And the answer is yes. You can choose to report everything at fair value. For example, if you have a whole lot of investments in your portfolio and you're worried about missing accounting for something at fair value, it's okay to report at fair value and just disclose that in the footnotes and policy. So you can choose a maturity of 0 days and just report the entire portfolio at fair value. Again, that is allowable. This is a policy decision, so whatever days you're going to use, whether it's 0 days, 180 days, or 1 year, which is allowable by the standard, just be sure you choose your policy and disclose that policy in the summary of significant accounting policies. And then more importantly, apply that consistently. So you can't change back and forth on an annual basis and say, oh, this year I think we'll use 360 days. Next year we'll use 180 days. Then the year after that, we'll just mark everything to fair value. So again, once you've got the policy, be consistent in the application of that policy. Now we will discuss GASB Statement 72, which basically gave us a new definition of fair value. Statement 31 talked about market value, but Statement 72 now says really the term we should be using is fair value. And Statement 72 defines fair value, as you can see on the screen, as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction. An orderly transaction means there's no related parties involved here. You're not selling a security between your general fund and your pension fund. So it's an orderly transaction between market participants, and it's measured as of the measurement date. So again, fair value is what we consider to be a market-based measurement. So the term market-based assumes that all potential buyers are equal. Fair value is what is the market going to pay at that particular date. So you look at the asking price, you look at the selling price, and you figure out what's fair value based on those two. Also, fair value is not entity specific. So not entity specific means that fair value begins with a broad definition and from there is adjusted for the specific traits of the transaction. So for instance, a motivated seller will typically drive down the selling price of an investment in order to gain time. Fair value does not consider a motivated seller to be a transaction trait. It is an entity specific trait. So that's the difference between entity specific and transaction specific. And last but not least, it's always an exit price at the measurement date from the perspective of the market participant that controls the asset or is obligated for that liability. So that's where we derive the definition of fair value from, is GASB Statement 72. So that combined with GASB Statement 31 tells us how our investments now are reported at fair value. So that brings us to our second polling question of the day. So I'll give you a couple seconds to get that answered. Yeah, be sure to answer that so you can get your CPE. All right. Now we will take a deeper dive into GASB Statement 72 and the specific application of the fair value measurement principle that applies to investments. So to start, we need to define what an investment is. An investment is a security or other asset that a government holds primarily for the purpose of income or profit and has present service capacity based solely on its ability to generate cash or to be sold to generate cash. So the application of Statement 72 is determined by the intended use of the asset at the time of purchase. Statement 72 introduces the concept of service capacity. The concept of service capacity focuses on intended use. If the intended use of the asset is to generate cash or to be sold to generate cash, then Statement 72 defines that asset as an investment. So capital assets, on the other hand, are typically not intended to directly generate cash. Most capital assets are used to provide services, and their present service capacity is based on their ability to provide direct services, not on their ability to generate cash, and that is why capital assets are not accounted for using the fair value measurement principle. However, if the capital asset is purchased with the intent to be sold at a later date or held for resale, the capital asset is considered to be an investment under Statement 72. The purpose, though, is determined at acquisition and does not change even if the usage of the asset changes. So, for example, an asset that is initially reported as a capital asset and then later held for resale would not be reclassified as an investment. So you don't change that. On the next slide are specific investments that are exempt from Statement 72, some of which are held by many local governments, specifically money market investments, 2A7 and external investment pools, and 2A7-like pools are exempt from Statement 72. And a 2A7-like pool is an external investment pool that is not registered with the SEC as an investment company, but nevertheless has a policy that it will operate in a manner consistent with SEC Rule 2A7 and allows money market mutual funds to use amortized costs to report net assets. Rule 2A7 was intended to make money market funds more resilient by increasing portfolio diversification and also limiting the types of investments allowed to be purchased by the pool to first-tier securities. Local government investment pools, such as MOSEP in Missouri, for example, meets the definition of a 2A7 like external investment pool, and therefore is exempt from Statement 72 and is reported at amortized cost. Next, we will discuss valuation. So there are three approaches to determining fair value: the market approach, the cost approach, and the income approach. And we'll go into more detail on each of those on the following slides. So in most cases, a single valuation approach is sufficient. The approach used to value the investment should be consistent from period to period. Now, if there is a revision to that valuation technique, then it should be treated as a change in accounting estimate. Each valuation technique can have various inputs. The strength of the input is defined by its level in the fair value hierarchy. So we'll first discuss the various valuation techniques, and then we'll get further into the fair value hierarchy of inputs. So first is the market approach. The market approach to measuring fair value uses prices and other relevant information generated by market transactions involving identical or similar assets or liabilities. Using quoted market prices is an example of the market approach. Another example includes the market multiples technique, which uses multiples or ratios such as price to earnings or market to book value to determine the fair value, or the matrix pricing technique, and this is used to value some types of financial instruments, such as debt securities, without relying exclusively on quoted prices. So this instead relies on the security's relationship to other benchmark quoted securities. The next slide discusses the cost approach to measuring fair value, which reflects the amount or cost that would be required to replace an asset. So from the perspective of the market participant seller, the price that would be received for the asset is based on the cost to a market participant buyer to acquire or construct a substitute asset of comparable utility. GASB Statement 72 also states that donated capital assets are required to be reported at acquisition value at the time of receipt. So the cost that you would pay to buy that donated asset at the time it was received. Next, we'll go over the income approach. The income approach to measuring fair value converts future amounts, such as future cash flows, to a current amount. When the income approach is used, the fair value measurement reflects current market expectations about those future amounts. So there are three valuation techniques for the income approach. The first is the present value technique, which is the present value of future expected cash flows. The second technique is the option pricing model technique. This is a valuation technique used to value an option contract that is based on critical terms of a contract and has implied volatility. The third technique is the multi-period excess earnings technique evaluation technique, which is based on prospective financial information associated with a collection of assets. The initial amount is reduced for the contributions of supporting assets, with the residual amount being the excess earnings associated with the asset being valued. On the next slide, lists a few things the government should keep in mind when choosing inputs for valuation techniques. So government should select inputs that are consistent with the characteristic of the asset or liability that market participants would take into account in a transaction for the asset or liability. Premiums or discounts that reflect size as a characteristics of a government's holding are not permitted in the measurement of a fair value. The thought is that this reflects the government's position in holding an asset or liability rather than a characteristic of the asset or liability itself, and therefore is not relevant to the fair value measurement and should not be an input. Another thing is if an asset or liability measured at fair value has a bid price and an ask price, the price within the bid-ask spread that is most representative of the fair value under the circumstances should be used to measure fair value, regardless of where the input is categorized within the fair value hierarchy. On the next slide, we will discuss the fair value hierarchy. So there are 3 levels to the fair value hierarchy. Level 1 being the highest priority and level 3 being the lowest priority. So level 1 inputs are quoted market prices for identical assets or liabilities that a government can access at the measurement date. Level 2 inputs are inputs that are observable for an asset or liability, either directly or indirectly. And level 3 inputs are unobservable inputs. If the fair value of an asset or liability is measured using inputs from more than one level of the fair value hierarchy, then the measurement is considered to be based on the lowest priority level input that is significant to the entire measurement. So for example, if there are 3 inputs significant to a certain fair value measurement, and then 2 of them are level 2 inputs and 1 is a level 3 input, then the fair value measurement would be categorized in level 3 of the fair value hierarchy for disclosure purposes, since that is the lowest priority level. Assessing the significance of a particular input to the measurement requires professional judgment and taking into account factors specific to the asset or liability. On the next slide, we look at a level 1 input. As I previously stated, this is a quoted market price for identical assets or liabilities that a government can access at the measurement date. A level 1 input will be available to many financial assets and many financial liabilities, some of which might be exchanged in multiple active markets. Therefore, the emphasis within level 1 is on determining the asset or liabilities principal market and whether the government can enter into a transaction for an asset or liability at the measurement date. Examples of level 1 inputs are publicly traded debt securities. For example, a quote on a Fannie Mae security from Yahoo Finance. This would be a market approach with a level 1 input. Other examples could be common and preferred stock along with mutual funds. As a general rule, any asset that has a daily closing price and is actively traded will be classified as a level 1 input. Let's see, level 2 inputs. So once again, these are observable inputs, either directly or indirectly. Level 2 inputs can be quoted prices for similar assets or liabilities in similar markets. Quoted prices for identical or similar assets or liabilities in markets that are not active. Inputs other than quoted prices that are observable at commonly quoted intervals, such as interest rates or yield curves, implied volatilities, credit spreads, and market corroborated inputs. An example of a level 2 input would be a bond valued by a pricing service that uses matrix pricing, and the level 2 input would be a price or yield on a similar bond. So the final level, level 3 inputs, are unobservable inputs. So level 3 inputs should only be used when relevant level 1 or level 2 data inputs are unavailable. Level 3 inputs are developed using the best information available under the circumstances. So in some cases, this may include the government's own data. Government should take into account all information about market participation assumptions that is reasonably available. A measurement that does not include an adjustment for risk would not represent a fair value measurement if market participants would include one when pricing the asset or liability. An example of a level 3 input would be a government-owned building where the value might need to be determined using the government's own data, and if there is no reasonably available information that indicates that market participants would use different assumptions. So as a general rule, level 3 inputs are those that are difficult to obtain on a regular basis and require verification from an outside party, such as an auditor or an appraisal to validate the valuation. So where can you find this information needed to categorize your investments by hierarchy level? And you can often reach out to your investment manager or advisor or your custodian, and they should have the documents needed to support and categorize those investments within the fair value hierarchy. And with that, takes us to our third polling question of the day. So we will give you a minute to get that question answered, and then Tom will take over on the accounting for cash and investments.
All right, perfect. Well, thank you, Victoria. Just a couple more seconds here. The polling question. So what we're going to be spending the next portion on is going through and diving deeper into some of the components of these standards. So GASB 31 being the first. So within GASB 31, we get some very specific guidance on both what we must include in presentation, as well as how things need to be recorded. But with, like any other standard, there are some exceptions to it. So there are some things that we can disclose but not present. On our next session, we'll go more in depth on the disclosure side of things, but we'll have a little bit of overlap between these two to go through these slides today. So GASB 31 on fair value reporting first tells us that all investment income, which does include that change in fair value of investments, is reported as investment income on the operating statement. So the standard tells us that, again, a few of the nuances to your presentation here. So changing fair value can, so is allowed to be reported as a separate component of investment income on your flow statement. If we have realized or unrealized gains or losses affiliated with our investments, and with that investment income, then those should not be reported separately. However, Statement 31 does give us the option to disclose those separately should we choose to do so. And then finally, negative investment income, which in and of itself sounds a bit counterintuitive, but it's a real thing. That must be reported as revenue. You cannot reclassify that and report that as an expenditure or an expense. Now, certainly during the current year and in 23, this wasn't an issue or wasn't really given a whole lot of thought given the market returns. But just prior to that in 22, we did see kind of a sharp decline in the overall market. So if you got investments on hand, you likely saw the value of those investments go in the red, go negative, resulting in that negative investment income. So in that instance, you would have had to present those brackets around your investment income revenue line to denote it was a loss. So just be aware that's something that will still need to be presented as revenue, regardless of how it ended up for the fiscal year. Go to the next slide. Thank you. So continuing the guidance from GASB 31, then tells us that all investment income, again, includes that change in fair value. Looking at the operating statement here and what should be presented as part of that investment income number. So any discounts or premiums affiliated with those investments should not be recorded or amortized if you're in a situation where those are being marked to market. So the reason being on that is when we're marking things to market, the amortization and the recording of those discounts and premiums is going to have the effect of misstating the fair value of the investments. So essentially, when we go through and do that fair value adjustment as part of the mark to market, that's already kind of factoring that in. So the market pricing is already factoring any of those associated amounts. So that's why we don't do that if we're marking investments to market as part of that process. Another situation you may have seen, circumstances where you have purchased interest on debt securities. So those purchased interest amounts should be recorded separately. And the reason we're looking at these types of transactions and isolating these is that there's a misstatement potential on the fair value of investments if you treat these incorrectly. So back to the purchase investments, if we have the first interest payment when you purchase the investment that crosses fiscal years, you're going to report that as an interest receivable. So you debit that interest receivable there. But if you have it where it's in the same fiscal year, it's actually going to be a debit to your investment income in those circumstances there. So again, just some of the nuances that we see in Statement 31 and things to be aware of as you're going through. and looking how you're reporting and how you're doing your accounting and financial tracking related to these amounts for your cash and investments, just to ensure there's no material misstatements of those values. Go to the next slide. Okay, so now we know what we can and can't report, but where do we report it? So where do we present investment income or interest income here? Statement 31 was very clear in telling us that the associated income with cash and investments should be reported and needs to be reported in the fund that actually earns the income where the investment's recorded. If there's a legal requirement to report it elsewhere, then that would take precedence, but ultimately the managerial requirement that comes into effect is that the income goes into the fund that owns the investment. And if there's other funds that you want to transfer those investment earnings to, then that's how you have to go about it. You have to transfer it. So for example, if you report a capital projects fund and have investment income earned in that capital projects fund due to the cash and investments that are held in that fund, then assuming it's just general pooled cash, not any sort of restricted amounts or legal requirements, but you want to move those interest earnings over to the general fund, you'd still report the capital projects portion of the interest in that fund, and then move the funds over via an operating transfer to the general fund. So this is something we do tend to see as kind of a common error in terms of reporting for your investments. And even more commonplace, if these amounts are not something that are being reviewed or reconciled or then allocated on a regular basis as part of your processing. So one of the things we'll take a look at in a few slides here is pooled cash and pooled accounts. If you do have a pooled cash or treasury fund type setup, make sure you have that set up properly. You want to be able to properly allocate that interest income where it needs to be, again, in that fund where it actually earns the interest, and then you can move it accordingly via transfer if you choose to do so. Next slide. So Victoria went through some of these, but there are other GASB pronouncements that are out there that address specific reporting requirements related to cash and investments. The impact of most of those is requiring different treatments in terms of a display standpoint versus a disclosure standpoint. But as you go through, if you're reading through those GASB pronouncements, Victoria went through earlier, and I'm sure you all will do so immediately after this training. But if you do notice there are some differences, or you're wondering why it says to present something here but then disclose some other component there, those differences are intentional. Excuse me, intentional. That's what GASB had intended on. It was all factored in, and you'll see that the guidance in GASB's basis for conclusions does address why some of those differences in terms of display versus disclosure are in place. And then I'll put in my little plug here again for where to find this information. So if you go to gars.gasb.com, you can access all of GASB's guidance, including like full standards, implementation guides, codification, lots of other resources, which is searchable and has links contained within to other references, other standards. So I always like to recommend going to GARS to try and research the guidance and information that you are looking for there. Next slide. So we'll shift gears here for a second from 31 and go to GASB Statement 9, which addresses reporting of cash flows for proprietary funds, non-expendable trust funds, and governmental entities that utilize proprietary fund accounting. So the guidance initially defines what cash and cash equivalents are. That's the first step as you go through and prepare a cash flow statement in terms of being able to present this appropriately. So within the cash flow statement, we can have a couple of different categorizations here as well, and we'll go through a couple of examples to show what that looks like. But for cash and cash equivalents, first you have your cash on hand or cash in your demand deposit type accounts. You may report or seen other reports that have terminology cash equivalents. So cash equivalents are defined as being readily convertible to cash. Maturity at the time of the purchase for a cash equivalent needs to be less than 90 days. Also noting that 90 days is the ceiling there. So you could choose a shorter time frame. You could say 30 or 60 days, just something to be consistent with. If you're going to say it's 90 days, and it should stay at 90 days unless you have a valid reason for changing that. So no need to change on a regular basis there. In terms of reporting, the remainder of the amounts reported on your cash flow statement then become investments for reporting purposes, and they're going to go impact the separate investing section on your statement of cash flows. Now with that, you want to make sure your system is set up to either mirror or match how the data is being presented and disclosed on the face of your financial statements. So it's just easier at year end for you to prepare those statements of net position and cash flow statements or to review those. And we'll go through a few different examples, like I said, on how this can be presented in a way that's easier to understand for a financial statement reader and to take away some of that potential confusion that could exist. Next slide. So a lot of that confusion could stem from amounts that a reader is looking at your financials that they can't understand where it's coming from, or if there's issues with the amounts articulating from one statement to another. So for example, like the statement of net position to your cash flow statement. So again, classification here, sometimes entities will use cash and investments. You may just see cash, cash equivalents, restricted cash. Many different ways this can be presented. There's no right or wrong version of it, just specific to your organization and what types of cash and investments you have. However, the important part is if you're going to present these different categories, just make sure that you do have that articulation from statement to statement. So here on the next slide, we'll go through our first example of a few. Here we're looking at a proprietary fund statement of net position. Within the schedules, you'll see under current assets, they're reporting both cash and investments as well as restricted cash and investments there. So looking at the water and sewer fund in this particular example, have about 22.2 million combined from the 20.6 in your cash and investments and the 1.6 in your restricted cash and investments. You go to the next slide then. Now here's the articulation comes into play. If we look at our statement of cash flow here at the bottom, you see cash and investments in total reported as the 22,228,040. So that amount does agree in total to those two balance sheet items in this particular example, but they're just not broken out the same way. So again, the totals here, but we're not really seeing that articulation of how the amounts actually agree from one statement to another. So they can continue to present this information, but the statement would be much more improved if they went through and added a separate reconciliation or modified the existing reconciliation to show that unrestricted cash and investments and the restricted piece of it as well separately. So breaking it out into the separate components that don't tie back to the statement of net position can be confusing to a reader of your statements. Next slide. So here's another example. Looking at this report, in our first column, we have cash and cash equivalents with the rounded figure here of the 12,231, and then cash and cash equivalents that are restricted of the 82,567. So again, presenting those amounts that are in the appropriate manner here, separately on the face of the statement of net position. But then if we look at our cash flow statement on the next slide, come to the bottom here, we'll have that total again. So again, we're not really seeing in this particular example the reconciliation of those amounts between the two statements. What you'd expect to see here is a line, showing the cash and cash equivalents, plus a line that shows that restricted cash amount, bringing you to that total of 94,798. So to be able to effectively and properly, reconcile this example, that reconciliation can take a couple different forms. So a couple different ways to be able to present that, which we'll run through here on the next two examples. If you go to the next slide. Looking here at the GFOA, Sample Annual Comprehensive Financial Report in this example, so cash and cash equivalents reported here, the 1,388,998. And in their case, they also have restricted assets for customer deposits, which they are classifying as a cash equivalent here of the 3,715. Going to the next slide, again showing our statement of cash flows here at the bottom. We'll see they've actually done the reconciliation in a narrative form versus a table format. So in addition to the cash number there, they've noted that the other amount that's being reported here is the 3,715 right there on the line description on the left. So in this case, the financial statement user is more easily able to determine what those amounts are and to be able to articulate and reconcile from the cash flow statement back to the position statement there. Next slide. So our last example here I'll run through, this is from the state of Illinois, June 30th, 22 annual comprehensive financial report. So as I mentioned, the previous example was done more in a what we call like a narrative format. This will look a little bit different than that. In this case, we're looking here at the non-major enterprise funds as an example. So you can see they have the cash equity with state treasurer, cash and cash equivalents, and then they also have down here in the restricted assets section, restricted cash and cash equivalents of the 8952. And then if we go to our next slide, then we can see at the bottom of the cash flow statement here, there's that reconciliation to show your total cash equivalents that agrees to your statement of net position. So see not only the cash equivalents, but then you also have the cash equity with state treasurer, as well as the restricted cash and cash equivalents. So again, clearly showing those three amounts from the position statement and the total of those. So as a reader, you can clearly see those amounts agree to the total reconciled cash flow figure as well. So just something to note, there are many different ways you can present the reconciliation in your cash flow statement, but the key being just that you're what you're trying to do is be able to accurately present the information from one statement to the other so that the readers of your financials can understand how they tie together. Next slide. All right, so we'll go back to the idea of the pooled cash for a second. So many of you may have seen pooled cash or have pooled cash for investing purposes. Oftentimes, this is done through a separate fund in your accounting system, like a treasury fund. That separate fund, because it's just more of an internal allocation tool, not something that's reported in those external financial statements, so not going to show up anywhere in your audit reports. When those funds are set up properly, each fund is going to report what's considered its equity in the pooled cash and investments. What you're not allowed to do as part of this when setting up cash or investment pools is you can't report everything in one fund. For example, like the general fund, and then report interfund amounts due to or from the other funds in order to allocate those balances from the general fund to the other fund. So the reason being on that is you're going to have an overstatement of your assets in your general fund. Your cash is now very overstated. And then you also have an overstatement of your liabilities in the general fund as well, because you're going to be presenting these due to other funds, but those are not true liabilities either. So the other part you have to be mindful of is when you get to the end of your year end, you may have individual funds that are reporting deficits. You cannot report those individual fund deficits in an internal pool. Sometimes those deficits come up often by timing differences or just temporary shortfalls. So those do commonly occur. You just need to reclassify those as interfund payables for reporting purposes. Many of you probably have heard or been asked the question as part of the audit process, which fund's going to cover the deficit in that particular fund. That's the purpose we're asking that question for. And then finally, while it's not common, if we do have a true bank overdraft, that gets reclassified and reported as a liability as well. Next slide. All right, so now we're going to look at securities lending transactions, which are governed by GASB statement number 28. So in the case of securities lending transactions, custodians may lend out your investments, and hopefully you do, but you may not even know about it, that it's happening in the background. You may ask yourself, why do we have these securities lending transactions, or what's the purpose of these? Where's my money? What's going on? But here's the why behind the security lending transactions. So they're used as a liquidity tool in the markets. The government serves as the lender. The broker-dealer is the borrower in this example. These are similar to reverse repurchase agreements, which we'll discuss here in a few more slides. So the securities are lent are reported as assets by the government. You also may have cash received as collateral or securities that are going to be reported as an asset as well. Then any of the amounts that are owed on the lending are reported as liabilities, and these are essentially classified as collateral that's owed back. And in this case, netting is not allowed on the statement of deposition or your income statement there related to these amounts. You need to present those gross. And we'll take another look at our State of Illinois ACFR again on the next slide to show a quick example of what this looks like. So again, here on the state ACFR, we have their balance sheet. There's more disclosures here in the footnotes for these transactions, but just showing you on the face of the financials for the purposes of today's session what it looks like. Here we can see they have securities lending collateral from the state treasurer, which is an asset on their books. And if we look down in the liability section, we see a corresponding obligation for the exact same amount as well. So again, not netted. These are presented gross, even though they do net to zero in total. Overall, with the security lending transactions, just a lot of information to go through. And frankly, the remainder of our slides are kind of the same, but just trying to hit some of the key points here on these, make sure you have a good understanding for some of the basics of these types of transactions. Next slide. Oh, and then our last polling question we have here for the day. Give you all a few seconds to answer that.
And as a friendly reminder, you will need to complete a total of 3 polls to receive CPE. All right, I will close the poll.
All right, so as I mentioned, looking a little bit more at repurchase and reverse repurchase agreements here. So looking at these 3 bullets under each of these, the first bullet point kind of being the action in these transactions, or what's happening here initially. Second bullet point is the promise or what will happen in the future in these transactions, and then the third bullet point for each of these is the goals. So what are we trying to do with these? So looking first at repurchase agreements, the government lends cash to a third party, either a bank or a broker. Then the bank or broker is then providing securities collateral for that agreement. They then have an agreement to repurchase the securities in the future. And what this does is it provides an alternative way to secure uninsured deposits with financial institutions. So you'll see this often, well, not often, sometimes as collateral for deposits. Before you look further into these as setting these up as collateral, make sure they're allowable under your investment policies. Then compared to a reverse repurchase agreement, again, the action here is the government's borrowing cash and then provides securities it owns as collateral. In this case, the government's the one who's then agreeing to repurchase the securities in the future, provided as part of this arrangement. And then ultimately the goal is, as noted previously, this is a tool for providing liquidity as part of this transaction. Next slide. So how do we account for and report the repurchase agreements and reverse repurchase agreements here? So as we tell us, it's dependent on the type of transactions we're looking at. These are broken down into 3 categories. You have plain vanilla, which involves the same securities, fixed coupon dollar. These are securities that have the same stated interest rates and maturities. And then yield maintenance, which are securities that have a specific yield associated with them. Under plain vanilla and fixed coupon dollar, those investments are included as part of the repurchase agreements, and those are disclosed as investments, not deposits. And then for yield maintenance types of transactions, these are buy-sell transactions. You're going to report those specific securities again in those setups as gross amounts, and no netting of those is allowed on your financial statements. Next slide. Now, another investment type you may have seen or heard about, may have, likely not, but are derivatives. Ultimately, we just don't see a lot of derivatives at the local level very much. So we'll just highlight some of the key takeaways here, some key understandings related to derivatives. Many of you may even have carve-outs or components of your investment policies that prohibit investments in derivatives. So it may not be something totally relevant to you all here, but still something we'll quickly touch on so you're aware of what's out there. So GASB 53 is what provides us some of the guidance on derivatives. Defines derivatives as financial instruments or contracts that have certain components to it. The first component being settlement factors, which includes reference rates and notional amounts. So reference rate, by example, is going to be something like the Fed funds rate or prime rate. If you've heard of those or familiar with those are considered reference rates. And then notional amounts refer to the number of currency units or other units specified in the derivative instrument itself. Leverage then is requiring no initial investment or requires an initial net investment that's smaller than would be required for other similar market-driven contracts. And then the final component relates to net settlement. Net settlement means the contract or financial instrument has to require or permit the net settlement. It can be readily settled by means outside the contract or provide for delivery of an asset to a recipient, putting them essentially in a position that would be not substantially different from the net settlement itself. So complex stuff here, very detailed, standard. There's a lot more in terms of definitions on derivatives out there, but again, just want to touch on some of the key points here. Go to the next slide. So a couple different examples to run through. Derivatives are regularly used as a risk mitigation tool. So different types of risk demand different types of hedging. So that's why derivatives can come into play. For example, you might see a cash flow hedge or a fair value hedge. Just depends on what the overall goal is with that derivative instrument. So some different derivative investment types include interest rate swaps. You're going to have either variable rate to fixed rate or fixed rate to variable rate. Interest rate swaps do require that there's a variable rate piece there. You have basis swaps. A basis swap is where payments are exchanged based on the change of two variable rates. You may have heard swaptions before. Swaption is something that gives the purchaser the option, so they have the right but not the obligation to enter into an interest rate swap. And then finally, a commodity swap is something that has the intent of reducing exposure to a commodity's price risk. And oftentimes you'll see that with like fuel or energy costs. They may have some sort of derivative type transactions associated with them. Next slide. All right, and then to wrap up our discussion here on derivatives, so accounting for these derivatives, for reporting at fair value, any changes in investment derivative instruments are reported within investment revenue on your financials. If you have hedging derivative instruments, those changes on those are reported as deferred inflows or outflows on your position statement until termination occurs on those. And then in terms of fair value reporting, how do you determine the fair value on these? First, you can look at the market price, if there is one. Next, you can look at the forecast of expected cash flows on those. And then finally, you can turn to GASB statement number 72, which Victoria discussed in detail previously. So overall, a lot of information, a lot of complexities that go along with derivative instruments and the various types of derivatives that exist. So just wanted to briefly touch on derivatives as a whole and some common examples that you may see. And with that, looks like we're at time now.
Perfect timing. Right on the hour.
Well, just wanted to thank everyone for your time here today. I know we ran up, right to the hour here. So if any questions you may have, feel free to send them in the chat, and we'll be sure to address those with you after the presentation here today.
Yes. Thank you so much to everyone for joining us. Thank you, Tom and Victoria, for taking the time to present today. And again, we will see that recording available on demand in the next week or so, so keep an eye out for that. Otherwise, have a wonderful rest of your day.
Thanks, everyone. Bye.